Ever wonder what's really powering your world? From Meta's clean energy deals to AI reshaping music royalties, change is in the air. Trump's steel tariffs are back in the spotlight, sparking old debates. Banks are quietly preparing for a credit crunch. But are you ready? And the Dow? It might not be telling you the whole story. Dive into the full video, because this isn't just news. It's the pulse of your financial future.
Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, how was your week?
Week was great, Gary. Pretty slow weekend. Just kind of hang tight at home, watch some golf. And I got Father's Day rolling up end of this week, U.S. Open. I'm a big golfer, so really excited about that. I know you're traveling. I don't even think we checked in where you're at, but where are you at in the world today, Gary?
I am in Lisbon, Portugal right now. Absolutely love it here. When I came, I bought a one-way plane ticket and rented an apartment for a month. But after a week and a half here, I'm thinking I might want to stay longer. I really like it. I might be a Lisboner or a lesbian. I have to figure out what the proper term is. Also, we have exciting news here. I believe next week is the Sardine Festival. So I'm all in for that. And then I'm really hoping that we'll have the Anchovy Festival while I'm here. I'm one of those heathens who likes anchovies on my pizza. If that bothers you, put it in the comments. Don't care. I'm still putting anchovies on my pizza. But yeah, there's a Sardine Festival here, and I think it's in about a week. I'm very excited.
Sounds amazing. We'll definitely need updates on that. We'll check in with you for next week's version of the 5 things. This week, though, we've got a great issue. A lot has happened in the headlines. Both what we'll be covering on the 5 things. I'm sure everyone's heard the Elon Trump spat. We've got riots in LA, craziness going all over. Craziness going down all over the world. But this week, we're talking about the nuclear AI issue on the 5 things to know in investing for this week. We're talking Meta makes another appearance. We've been talking about them in the last couple of weeks. We're talking about AI and artists' rights as it relates to music, President Trump and tariffs. We're talking banks. And then, of course, we'll get to our educational topic for our 5th and final thing. Gary, first thing to lead us off this week, we're talking about Meta. We're talking about nuclear here, the good kind. Thing number 1, Gary, Meta goes nuclear. Excited to hear about this one.
All right. So Meta, the company formerly known as Facebook, just signed a 20-year PPA, that stands for Power Purchasing Agreement. The agreement is with Constellation Energy. It secures a multi-decade contract for nuclear power. It meets Meta's stated desires for carbon-free electricity for AI applications. And, the reason that's important, Rob, is because AI data centers, you need like 5 or 6 nines reliability. You can't power this stuff with, solar or wind. It really needs to be up all the time. But for, political reasons and for marketing reasons, Meta doesn't want to be investing more in carbon-based electricity. So the only solution here, if you want to have carbon-free, inexpensive, reliable electricity, that's nuclear. There's no other option. Constellation will be providing the energy from their state-subsidized Clinton Clean Energy Center in Illinois. I've been practicing that all day. And in an additional benefit, this project will eventually transform that energy center into a private market plant. So Meta is not only securing their energy for an AI future, they're doing so in a reliable, carbon-free way, and they are turning something that has been state subsidized into privately funded. This is a win for everybody. It's worth pointing out that individual data centers are research labs that use enough power to supply entire cities. And tech companies like Meta, they're under huge social pressure to do it without increasing carbon emissions. And they're following in the footsteps of Amazon, which just did a deal earlier this year with Talent Energy. That is a DKI position, thanks to Enrique Abeda at HX Research. We've made well over double our money in that position for DKI subscribers. But they are, a similar nuclear provider, and they just sold a ton of power to Amazon in this kind of deal. So we'd love to see stuff like this. These government subsidies, I think, are going to be stopped, and that money will be supported by Meta starting in 2027, justifying further investment in the plant. So again, this is a win all the way around. We're happy to see it.
Yeah, Gary, obviously, as DKI subscribers, we love seeing more and more companies secure nuclear power, just leveraging nuclear. What's the way to profit from this type of demand that we're seeing, that AI is creating? And as you've gone on record saying, hey, nuclear is the best option here, but what's the profit path?
Okay, so that's a great question, because the key thing here is we are going to see an enormous increase in use of nuclear energy. China is building a huge number of plants. Europe is looking at new plants. Here in the US, there's more demand for nuclear power. President Trump announced, just a couple of weeks ago, efforts to create more nuclear power on military bases, providing additional supply. All of these things are going to use more nuclear power. It's also worth pointing out, we are trying to do something here in the US that's never been done before. We are trying to recommission 3 previously decommissioned nuclear plants, most of them in the Midwest. So there's all of this demand for uranium, the fuel for this. One of my largest positions personally is in uranium. Personally, I like the physical rather than owning the miners. We've looked at companies like CCJ, that's Cameco in Canada, Kazatomprom, but there are issues. Cameco right now is underproducing, and they also, it's expensive. It's expensive to build new mines. So they're underproducing and actually overpaying in the spot market to supply long-term contracts at a loss. Kazatomprom can't get enough sulfuric acid to process the uranium. So there are all of these supply issues. We talked about this in last week's version of the 5 things. So we like owning the physical. If you want to know what ticker, what investment we're using for that, feel free to subscribe. That's something that, we've saved for DKI subscribers. It's a position where they've made a ton of money, but if you think it's too late, it's not. I just increased my personal position a week ago in this. Last week, I was updating DKI subscribers that I was buying. That position was up a huge amount today. We're not short-term investors, but it's always nice when you buy something that goes up a huge amount, within a week. That was nice to see. But yeah, we are playing this with huge positions in the physical spot uranium market.
Yeah, I love it. And I think it's great for the thesis too, Gary. We've obviously seen over the last just month and a half ramp up, and then further doubling down on what is positive thesis that we're seeing in nuclear, uranium, and obviously the AI demand as it only continues. And keep reminding subscribers one thing, Gary, you've said, these are your words. When there's good technology, what happens is people tend to want to use it more and more and more and more. So that huge compounding growth, and especially when it comes to AI. Anything else there, Gary, before we move on to the next thing?
Yeah, one thing is really amazing. I have plans to travel for a year, and I spent my whole first month of being out of my house in the US, traveling around and seeing, people I really care about. But 3 of the people I spent time with are all on the DKI board of advisors. They are all personally doing a ton of stuff with AI. I just got off the phone with a close friend of mine who has amazing ideas on ways this technology can be used. I've started to use it not only for DKI's research, but also for trip planning. I'm looking at going canyoning and heading to Porto this weekend. I literally just went into ChatGPT and said, these are my parameters. This is where I am. This is what I want to do. And instantly ideas with links came back. So I'm using it more and more. People on the DKI board are even building, Kit MacArthur is building his own at-home LLM to forecast energy demand and pricing. I mean, the amount of technology that's being used and expertise we have just in-house on this is incredible. So I don't think this is something that's going away. I think we have to assume that the demand is going to be increasing.
Yeah, I completely agree. I mean, same thing on our side. We even have projects that are pipelined for AI development. We have our own tool that services almost every single one of our SEO clients, supporting content production and scaling, and then just utilizing, your regular GPTs and LLMs. And super excited. We have an MBA intern starting over the summer, and she's working on same thing, her own proprietary LLM forecasting and predicting and modeling U.S. auto market and auto industry. So super excited to work with her. And I think what you're seeing too is the young people are heavily investing as well, right? So once these people start to get out of school into the workforce, I think you're only going to see more and more adoption because it's going to be championed by new employees coming into the marketplace as well, because those tend to be the guys that are utilizing this AI at pretty superior levels.
Yeah, I agree. And, Rob, think about this for a minute. People generally, most people don't think a whole lot about electricity supply. We've all grown up in a world where you just plug something into the wall and it works and it's like magic. And my whole life, with the exception of a few storms here and there, anything plugged into the wall just magically works. But you build just one AI data center, and remember, there are literally thousands of them that have already been built in the US. You build one of those, and that uses as much energy as an entire city. So we need to build an enormous amount of additional capacity. Certainly we do have access to oil and natural gas, like, carbon fuels, but that's not politically feasible right now. It doesn't actually matter right now whether any of us believe in this environmental belief or that one, or like our personal beliefs don't matter. It's just not politically feasible. So we're not going to be building more coal plants. We will be building more nuclear.
Great. Yeah, great stuff there, Gary. And we'll be sure to keep you in tune for what's happening in the nuclear market. And as Gary said, if you want to unlock that current recommendations tab to see the uranium positions that Gary may be in, then you can sign up for a premium subscription on our website. Staying in the lane of AI, Gary, thing number 2, we're talking about the 3 big music labels. They've been working a deal having to do with AI, the use of their artists' music. You reference in the written version, this is better than going after and suing college kids for AI infringement or whatever, or rights infringement, whatever else it may be. Thing number 2, Gary, the music industry is betting big on AI, further just advancing what we were talking about previously.
Yeah, so we have a really interesting situation in AI related music. Basically, so people understand the way the LLMs work, the large language models, or what people know to be generative AI, things like ChatGPT or X's Grok, or Llama, or Gemini. What they do is you feed into them tons and tons and tons of information, and it starts to make comparisons, and it starts to understand the relationships between these things. So we've all seen the things before where you say, okay, well, write me a song that sounds like something that Katy Perry would do, that sounds like like lyrics from the Rolling Stones with a bass line from some great funk group like George Clinton, right? And we've all heard that stuff before. Well, in order for those things to work, in order to make a song that sounds like something Taylor Swift would do, or the Rolling Stones would do, or any whoever your favorite group is, the LLM needs to be trained on music from that artist. All of their music is fed in. And so what the artists are saying is, wait a minute, you guys are using our IP. You're using our copyrighted music, and you're using it to turn out something that sounds like me but isn't me, and shouldn't I be paid for that? Further complicating things, there are 3 big music labels in the United States, or really in the world. One is Universal Music Group. One is Warner Music, and the reason I had to change that to be in the world. The third one is Sony, which is, of course, based in Japan. And those 3 labels own the rights and the marketing rights to most of the big artists in the world. And they're saying, yeah, we would like to get paid for this. You guys are making music based on something our artists have done. We should get paid. And so what they're doing is they're in active discussions with AI music startups like Suno and Udio to license their whole catalogs for use in generative AI models. And what that will do is it's an attempt to ensure that artists and labels receive compensation each time their work is used in training models and creating new tracks. And, you know, obviously these negotiations come amid, because it's the music business, ongoing copyright lawsuits and increasing pressure. One of the things that makes it hard is the legal framework for dealing with this stuff isn't fully fleshed out yet. Now, obviously, the legal framework for copyright is very well fleshed out, but it's not crystal clear what it means if you, like, think about it this way, Rob. Let's say you and I formed a band and we said, wow, you know, we really like this kind of music or that kind of music. And we made music based on the music we like, but the way we decided we liked it was we listened to other people's music. And you can draw like these great lines, you know, where, people like James Brown, their music was then used by groups like Tower of Power or groups like George Clinton. And those groups all influenced an artist like Prince, right? Like, can you sue them? No. Everybody listens to other people's music and makes other music that sounds similar, and they influence each other. And there's a reason that different genres of music have certain characteristics in common. But what does it mean if you use a computer to scrape somebody's entire back catalog and then produce music that sounds like them? That there are going to be lawsuits, and that part of the law is not fully fleshed out quite yet. So what the labels are doing in trying to avoid litigation, they're pushing for systems like YouTube's Content ID system, which enables royalties tracking and in some cases equity stakes. And this could potentially not only resolve existing lawsuits, but set an industry-wide precedent for how creative rights are managed. And the beauty of that is you don't need to settle that in court. If all the parties come to an agreement and decide it's fair, then nobody goes to court. You don't need to expand on the legal framework. So it also could establish a new revenue stream. That's what they're going for here.
Yeah, so I mean, Gary, is this a situation where the content creators or IP owners, the artists, I mean, are they going to receive compensation directly from these companies for LLM training? Are they going to actively train? Or, I mean, what does that compensation look like?
So it's not done yet, but the way these things are typically done is the music labels will usually have responsibility and an incentive to figure out who owes what and go collect. So, you know, for instance, if you are an artist and you hear your song played in a place or in a way that it shouldn't be without compensation, the artist isn't going to, you know, go knock on somebody's door and say, hey, write me a check. It's typically the music labels that go looking for people who are using music and saying, you owe us money, you know, send it to us. And then what happens is they've set up systems so that the artists can audit that. And it used to be a couple of times a year, and then it went to a monthly basis. And now, like, some of these artists are actually getting daily reports. And when that happens, the big three labels they'll defend the copyright, they'll collect the money, and pass on to the artists their share of all that. Now, one thing that I think is really interesting is we have started to see some threatened lawsuits in writing, right? The newspapers have said, wait a minute, you know, these LLMs, you've been scraping 100 years of our newspaper writing, either don't do that or pay us for it. So it's really interesting that in this situation, it could be the music labels leading the way to some sort of collaborative agreement. And it'll be really interesting to see what happens with newspapers, publishers, authors, you know, people who write books or blogs. You know, like, I don't know, is somebody scraping the Deep Knowledge Investing blog and training an LLM on what we're writing? You know, for that, should we be paid for that? I mean, these are really interesting questions, and they're threatened lawsuits. So the answer to your question is it'll be the music labels collecting, but it'll also be interesting to see if people who are in the written business, whether it's newspapers or books, try to follow along in the same direction.
Yeah, it's interesting. I didn't kind of got ahead of it, and just on even basic chat GPT, I think it's 4.0, but the GPTs that you can create, right, where I'll just go on voice record my thoughts, and I've turned it into a Ask Rob SEO, Ask Rob Business, right, to where, connected on our website, or we're even using it internally for certain procedural things, to where, okay, instead of coming to an actual human for the question, go to the GPT that can generate the answer, and we're not wasting time having to search for answers or find what people might think. It's all built into the GPT itself. So super interesting there. Gary, follow-up question too. I mean, how much of this is a change kind of in strategy for the music industry as well, right? I mean, for them, I obviously see, hey, they're looking at it from protecting their artists, but then just revenue stream and strategy adjustment with the changing dynamics of the market.
Yeah. So first of all, my version of Ask Rob is I just have your cell phone. I just call you or text you. I actually ask Rob, which is I find
Trying to
incredibly
eliminate
convenient.
self here, right? That's what we're trying to do with AI, right? It seems to be.
Either that, or maybe we should post your cell phone number in the chat or in the comments in the description and see how that goes. But at any rate, look, you're asking a really important question, because if we go back 25 years, and yeah, it's that long, and some of our viewers may not remember this, but the music business used to have these really high margins, and there was a period of time when the only way to get a digital download was to pirate it. It wasn't until less than 25 years ago that Apple came up with the Apple Music Store, which hurt the music business in a completely different way. Normally, you'd have to buy an entire album for like $15 at the time. And, the issue was, you were typically buying an album might have like 8 songs on it, but you might only want 1 or 2, and you had to buy the whole album for that. And then, Apple made it possible to pay 99 cents per song. So you got everything you wanted off of the album for $1 to $2. But before they did that, there was a period where if you wanted to listen to digital music, if you wanted to have something, on like a media player, and this is before everybody was carrying around cell phones, the only way to do it was to pirate that music. And the music business, instead of adjusting to the technology and finding ways to make digital downloads possible, to make them legal, to work with people, to just say, hey, listen, we don't love that people are pirating our music, but at least they're listening to it and passing around. It's free advertising. Kind of like artists put their music on YouTube now, right? I mean, there were all these great solutions. The artists now put their music on YouTube for free and say, please listen to it, pass it around, send your friends a link, right? Please like, subscribe, and share. They weren't doing any of that. And they made the horrible choice to start suing college kids. They started going after college students for thousands of dollars, which, didn't really stop anybody from pirating music, but it made the labels look like bullies. When Universal Music, which is the largest music label in the world, was suing college students for thousands of dollars because they were downloading a few songs they liked in a dorm. I'm not arguing that what the college students were doing was legal or right. I'm just saying it looked really bad, and it ended up getting them a ton of bad publicity. Everybody looked like an idiot here. I think what they're doing right now, I think they've learned from the past. I think if the music labels had it to do again, they would not have sued college students a quarter century ago. This time, they're going to the people that they think are using their artists' IP, their intellectual property, unfairly, and saying, hey, let's work out a deal. Let's come up with something that works for you, that gets us paid, that allows us to pay our artists. Let's collaborate. And I think it's a much better approach, because suing college students for $10,000 just isn't a good idea. It just made everyone look dumb.
Yeah, no doubt about that, Gary. So definitely think better approach this time around for the music industry and the labels. But again, I think the big picture is AI development. It's coming fast. Industries are being disrupted. Technology is really strong and powerful, right? And we're still have not even, I think, harnessed the complete power of what AI can do. You're watching this week's version of the 5 Things to Know in Investing with Deep Knowledge Investing. I'm Rob Farron here with Gary Brode, managing partner of Deep Knowledge. This is the nuclear AI issue. We'd love if you head to our website, deepknowledgeinvesting.com, sign up for a free subscription. Also consider our premium paid subscription. That'll get you access to all of our current recommendations and premium content. And definitely subscribe. Same place, same time on a weekly basis. We'll release this 5 Things show on YouTube, as well as we'll have multiple shorts and just individual breakdown clips of the topics that we're discussing on the full version of the show. And Gary, moving on to thing number 3, we're talking about President Trump and, yeah, you guessed it, tariffs. You put in the 5 things. The usual suspects do the usual dance when it comes to the news about President Trump and the tariffs. Gary, thing number 3, President Trump doubles down on steel tariffs, steel and aluminum tariffs. Tell us what we need to know there, Gary.
Well, the first thing, Rob, is to know that the usual people are panicking and the same hysteria has started again. It's all, it's all over, man. It's all over. So President Trump announced on June 4th that tariffs on imported steel and aluminum will increase from 25% to 50%. That does exclude the UK. And he declared the move necessary for national security. That's a good point by him, by the way. And to strengthen the domestic metals industry, also a good point. The American steel stocks immediately went up. Cleveland-Cliffs was up 28%, but the automakers did not do so well on that. Analysts who don't ask me how they came up with these numbers. They warned the tariffs were going to raise vehicle production costs by $2,000 to $7,000 per car. And of course, what do? They threaten to pass those increases to consumers via higher prices. In other words, President Trump, does what he does. And everybody says, okay, well, everyone, your car is going to cost $7,000 more, and we get hysteria, right? Automakers predictably criticize the timing and scale of the hike, warning that sudden cost escalation is making planning and investment decisions nearly impossible. That is also a fair point, right? Like, it's not, I don't know that they're going to be right on the price increases, but they are right. It's very hard to make planning and investment decisions when you don't know what your costs are going to be or where you're going to be sourcing from. That's a valid point by the automakers, but that's basically, where we are right now. We'll see what actually goes into effect.
Gary, we talked about, both sides of the aisle, people being upset, people that love it. Let's talk about who's upset by this. And I mean, do they have a valid point when it continues to when we continue to talk about these tariffs and what seems to be increasing tariffs across the board?
So here's what I find really interesting. So of course, we got the usual hysteria from fiat economists who only somehow seem concerned with US tariffs. Let's talk about the other large steel manufacturers in the world. China, India, the EU, and Japan, guess what? They all support their domestic steel producers, and somehow the EU and Japan manage to produce high quality vehicles while China is becoming a force in EVs, electric vehicles. So why is it then that the EU and Japan manage this perfectly fine? China is growing their automotive fleet. India has a healthy steel production with some sort of domestic support. These countries have tariffs. Why? How do they manage? And why weren't these fiat economists livid and upset? Why weren't they saying, oh no, these economies are going to be in horrible shape as a result of their steel tariffs or supporting their steel industries? The fact is that the move to protect domestic steel production is related to national security. Automakers are facing market pressure from EV competition, and now they are concerned about higher steel prices reducing margins. I'll also point out, as somebody who grew up in the Detroit area, lovers of the old Detroit muscle cars will point out that the new cars have 20 to 30% less steel, much higher prices, and in my opinion, 72.5% less character, right? Detroit produced a lot of fun stuff back in the 50s and 60s, a whole lot more interesting and fun and exciting than some of the nonsense is being put on the roads today. These, Econo boxes that all look exactly alike, and they're not fun. My daily driver is an E46 M3. That car is almost 25 years old. It has a manual transmission. It is fun to drive. I had to take it into the BMW dealership a couple of years ago. They gave me a brand new 320. I brought it back. The salesman, or the service advisor hoping to make a sale said to me, "What do you think of the car?" I said, "It has all the charm of a late model Buick," right? They're not fun. So, the point of all this, my aesthetic preferences in automobiles aside, the point of all this is somehow everywhere else around the world manages to produce cars and protect their domestic steel industry, but somehow President Trump talks about increasing tariffs on steel here so that we have a secure national security issue resolved. And all of a sudden, that's going to crush the economy. How does everybody else do it, right? I'm just not buying the logic. There's no internal consistency. These guys seem to work under the idea that everything is fixed, and President Trump changes one thing, and oh no, the world is falling apart. But the world doesn't really work that way. We'll see what happens.
Gary, in terms of U.S. steel production and supply, I mean, is there anything that's being done to increase that supply?
So, Rob, that is more than anything else the key question. And, we've talked about this on the show a lot. All these fiat economists keep saying the tariffs are going to be inflationary, and our response is maybe. They might be, but if you go back through history, there have been lots of tariffs that didn't lead to increased price indexes. And the reason for that is because we ended up seeing an increase in domestic supply. So when you bring in less of a foreign good, your domestic manufacturers have more of an incentive to produce more, and that will often keep prices in check. And that's what's happened in the past. So worth pointing out, we just a couple of weeks ago got a new deal between U.S. Steel and Nippon Steel. This has been going on for years, where Nippon Steel has wanted to buy U.S. Steel. There's been concern from the Biden administration. There's been concern from the unions. President Trump did manage to put together a deal there where there will be a board of advisors to ensure that U.S. interests are being observed and maintained. But part of the deal is to ensure an increase in capacity. And there are now new billions of dollars of new steel investment being made by Nippon Steel to increase that capacity. And when that happens, I think that's something the Detroit automakers will welcome. Somehow that got left out of the hysteria.
Thanks for all that coverage there, Gary. And as always, with tariffs and that evolving conversation, we'll keep you in tune with everything you need to know on a weekly basis with what's going on with that topic. Gary, moving to thing number 4. We talked about this a while ago, and we haven't talked about it recently, but we're going back to consumer credit, consumer debt. Banks have actually increased loan loss reserve as more leveraged customers go more delinquent on higher balances. Obviously concerning. Gary, you said this concerns you as well. Thing number 4, major banks are preparing for credit stress, back in the headlines.
So in this case, we're going to go to the graph, and credit here to DKI intern Cash and Crow, who put together this graph for us. Also, other DKI intern Samak Jain doing a fantastic job. Our young people really knocked the ball out of the park on the research and graphs and the writing. They do a ton on the 5 things. They deserve credit by name. Happy to give it to them here. In this case, this is a graph put together by Cash, and if we go back to right around 2021, consumer credit use was under $800 billion. That has now risen to about $1.1 trillion. That is a big increase, right? We're talking about a 35-40% increase in just 4 years. And predictably, the delinquencies have gone from about 1.5% of balances to more than 3%. So the delinquencies are up a little under 3x, maybe 2.5x in that time. Now, is that a huge disaster? No. If we go back to like the 2008, 2009 great financial crisis, the delinquencies at that point were right around 6.5%, 7%. That was a whole lot worse. But it is a big increase. And as a result, the big banks are starting to take larger loan loss reserves. So, from an accounting point of view, don't tune out yet. I know once you hear that, it sounds boring, but we're going to keep it really simple. From an accounting point of view, when a bank makes a loan, they're recognizing the profits from it, but they say, hey, we've just made this loan or extended this line of credit. We expect that there will be a certain amount of losses associated with it. And so what they do is they take a reserve against it. They're called loan loss reserves. And then when their customers go delinquent, meaning, or they haven't paid for 30 days, they're delinquent. And at 90 days, they start charging that off. When they charge it off, meaning they say, we're not going to be able to collect this, then they take that, they make a charge against their loan loss reserves. That's the accounting version of this. And so what the banks are seeing is, wait a minute, we're seeing an increase in delinquencies on higher balances. As a result, what are we going to do, right? We're going to increase our reserves. That's reducing profitability there. And the banks are right to do that because, like we said, Americans are carrying larger balances, expressing less confidence in their ability to pay them down, and that's creating tension for the U.S. banks.
Yeah, with that, Gary, I mean, what should individuals be doing about this? Does this speak to, just individuals understanding? What can our educational system, is a gap there, right? Just with how people manage their finances and the lack of understanding. What should people be doing with this information?
Yeah, so, there are a couple of things going on here, Rob. First of all, people are starting to use buy now, pay later for their groceries. That's a really bad sign. But generally, when people are using those kinds of financing for groceries, it's a sign of severe financial stress. If people don't have enough money to buy groceries, then they're going to do what they're going to do. And there's not much that we can do to advise them. I mean, any advice that we'd give would sound really obnoxious, telling people we'll just make more money or just spend less when they're financing their food is just insensitive and not effective. And I don't want to be saying that to people. But for everybody else, I just point out a couple of things. If you're starting to feel financial stress, look for places that you can cut back. And on a personal level, I just did a show, and I'll be releasing the link on this. But I did this with Carrie Lutz, where we were talking about the fact that I rented out my house for a year. Now I was in a position to do that, but the rent that I get on my house, where I'm now living in much smaller apartments all over the world, I'm living a fun, interesting life that way. But it also saves me a lot of money. That's what worked for me. But for other people, it's okay to look for ways to reduce your expenses a little bit, and that will help certainly a lot. More than that, I can't change the fact for people that wages haven't kept up with inflation in decades. That's a disaster. But there's not much that I can say about that. When people, like I said, are using credit and buy now, pay later to afford groceries, that's a structural problem. And again, there's not much that we can do to help people with that. But it's really important to point out that our educational system intentionally avoids teaching students about budgeting or about finance. Too many young people use buy now, pay later, and later they're shocked when they receive bills. That's crazy, right? To be spending money and not realize that you're going to have to pay it back, to pay those loans back later. That's an education problem. And that's something where people should understand the financial services that they're using, the financial products they're using. We're doing what we can in this show to educate people. I advise people, to the extent that you are able, please avoid buy now, pay later. It doesn't solve your financial problems. It just delays them. The banks are right to prepare for escalating credit problems, but for everyone else, we're doing everything we can to help you better understand what's going on in the financial world. I can't fix the fact that the system is skewed against you, but we'll do all we can to help you make better financial decisions and support you in that way.
Yeah, well said, Gary. And if you do have any questions, head to our website, deepknowledgeinvesting.com. You can actually use the Ask Gary feature. Can answer any questions that you may have about information you've heard on the show, what you might have questions about related to portfolio, the whole 9 yards there. You can also email us at ir@deepknowledgeinvesting.com. And then when you head to the website, be sure to grab a free subscription. All you need to do is enter your email, as well as you can head to our subscribe now and see the different premium options we have, both individual, family office options for you there. Moving forward, we're going to wrap up this week's 5 things with our educational topic. Again, this is the nuclear AI issue. Today, Gary, we're going to be talking about understanding the major market indices, going through and breaking down each one of those. But before we get into the individual ones, Gary, why don't you start by giving us high-level understanding and definition of what is a stock market index?
All right. So have any of you ever heard the expression, the market was up today, or the market was down 1%, or the market was up 400 points or 1,000 points, or it was down 152 points? What does that mean? What is this market? What does it mean that it was up a certain percentage or down? Like, is that all stocks? Is that some stocks? How are they calculating that? What does it mean? And we're hoping that by explaining this to you, you will understand the language of finance better and understand that when people talk about the market being up or down, what exactly that means, right? What are people referring to?
Yeah, now, Gary, there's obviously, as we know, multiple indexes. We're going to talk through some of the most popular ones here. They both have kind of different quirks you use as a term, which I thought was a great one, a makeup of the individual index. So let's start, Gary. Tell us about the Dow Jones Industrial Average. You'll hear it commonly referred to as the Dow, DJI, acronym. Tell us about the Dow.
So the Dow Jones Industrial Average is the oldest market index out there. It's certainly the most famous, and it's a price-weighted index of 30 large U.S. companies. And they're typically, large cap companies that are industry leaders, solid reputations, big growth prospects. It's sort of like the old money country club. If you get the invitation to join, you're a really big deal. You've made it. The big issue, there are 2 big issues with the Dow. One is it's only 30 companies, right? 30 large companies. But the biggest quirk of the Dow is that the index is price weighted, which is a completely insane way to put together an index. And price weighted means that each stock's influence on the index is determined by its price per share. So a high price stock in the index will move the index more than a lower price stock, but that's irrelevant when it comes to market cap. So to give you an example of how silly all of this is, let's imagine that you have a company that's in the Dow Jones Industrial Average, and you have a certain weighting in the index. If you were to do a 2-for-1 stock split, and typically when a company does a 2-for-1 stock split, the price per share will be cut by 50%. When that happens, that company's influence in the index gets cut in half, right? It's nothing about the company's changed. Its earnings haven't changed. Its revenue hasn't changed. Its growth rate hasn't changed. Its multiple hasn't. Its market cap is the same, but its influence in the index is cut in half. Now, that's a legacy from a time when people didn't have computers, right? And this index is literally hundreds of years old. And so you really wanted to be able to just sort of do it quickly on the back of a napkin and didn't want to be in a situation where, you were trying to figure out the weighting of individual companies and doing market cap calculations. Nobody even had calculators at the time. It would have taken a long time. So I understand the reason it was done the way it was done. It made the calculation very, very simple, but it's just a weird, quirky way to calculate a market index. It's still popular largely just because of historical weight. It's just been around for so long that it's what people think of. That's all.
Makes sense. Gary, moving forward, let's talk S&P 500 now. Obviously, another index that people, I'd say with the Dow, the S&P 500, probably closely behind in terms of indexes that people are watching.
Yeah, so the S&P 500 is a market cap weighted index made up of 500 large US companies. It is typically considered to be a proxy for industrial America, right? They're 500 of the largest companies in the United States. generally the health of the S&P 500 will give you a pretty good sense of the health of the US economy. Just a reminder, when I say that, I'm talking about things like revenue growth and earnings growth, not necessarily the stock price or the value of the index, which, you could have the multiple go up, which is a big part of where we are right now and why I'm a little bit concerned about market levels. Now, when I say it's a market cap weighted, what that means is that a company with, say, a $3 trillion market cap, there we're talking about companies like Apple or Microsoft or Nvidia, will have 3 times the weight in the index that a company with a $1 billion market cap will have. Okay, so that seems reasonable. That makes sense. But here's the quirk that leads to. If we take a look at the Magnificent Seven stocks, right, these 7 large tech companies, the mega caps, those 7 stocks make up roughly 33% of the index, while the other 493 companies account for 67%. So 1/3 of the index is 7 stocks, 2/3 of the index is 493 stocks. So that will make the index very, very weighted to a small number of companies, largely in one industry, in technology. They're very heavily weighted in that direction.
And then, Gary, finally, let's talk about the NASDAQ Composite. That will be the final index for today that we'll talk about. Tell us more about the NASDAQ.
All right, so the NASDAQ Composite Index, that's also a market cap weighted index like the S&P 500, but it is the market cap weighted index of all common stocks listed on the NASDAQ exchange. So unlike the Dow and unlike the S&P 500, which are only large companies, the NASDAQ includes both small and large cap stocks. So far so good, right? I mean, that's great. So we've got market cap weighting that makes more sense than price weighting. And we have a large number of companies with a wide range of market capitalization. So we should be good. What's the quirk here? The quirk here is that the NASDAQ is heavily weighted toward technology companies. That makes up roughly 59% of the index. So where the NASDAQ is a much broader index, the fact that almost 60% of the index is in one industry skews things in that direction. So basically, to summarize all of this, right, we've given you a clear understanding of what these indexes are. When someone says the market was up, the market was down, this is what that means. But it's really important to remember that every one of these indexes has some sort of weird quirk that makes the calculations a little bit strange, a little bit inaccurate, a little bit skewed. And that's okay. Like, it's okay to have some sort of inaccuracies or quirks in the calculation. The thing that's important is that you understand what they are, that you understand what they mean, so that you can take the right meaning away from it.
Yeah, I think you nailed it right there, Gary. They all serve as benchmarks, but understanding the nuance, what makes up the weighting, I think is important when determining, okay, what exactly this means from a financial news perspective. That wraps up this week's version of the 5 Things, the nuclear AI issue. Thank you so much for listening and watching. Again, be sure to head to deepknowledgeinvesting.com, grab a free subscription. We'd love if you consider a premium subscription as well. You can always subscribe to our YouTube channel. Thumbs up, thumbs down. If it's thumbs down, though, let us know what we did wrong. We'd love to hear it. That's what gets us really excited about doing this show. Gary, I'm going to turn it over to you for the final closing thoughts.
Thanks, Rob. So as usual, another great week from our young interns, Cashin and Samaksh. Really incredible to me. Sam was working as he was traveling back from Hyderabad, India, back to New Jersey in the United States. Cashin right now is in Eastern Europe. He's headed back to the United States tomorrow and will be doing the CPI fire drill on Wednesday morning with me at 8:30. Great work ethic by these young men. Really great to see. All 3 of us were in different countries. As I said, I'm in Lisbon right now in Portugal. We were all in different time zones, and just everything always works and keeps moving forward. It's just a great work ethic and flexibility here at Deep Knowledge Investing. We're big on rolling with the changes. Also want to thank you and the team at Flying V, Rob. You guys just keep pouring resources and help into the 5 things. It's a huge benefit. The team there, Jonalyn and Alex, Nazim the Dream, Anton, everybody there, and you, of course, filming this show with me every week. It's just such a blessing. And then for everyone who's watching this, we know your time is valuable. Thank you so much for choosing to spend it with us. If you want to give us a like and subscribe, that would be great. We'd love it. But hey, do whatever you want. We're not the boss of you. Looking forward to seeing you next week.
Thanks, everyone.